Hi everybody. Today we're going to be talking about the perpetual inventory system from the buyer and seller standpoint. And what I'd like you to do is take a look at Exhibit 5A4 on page 309. We're actually not going to be following this exhibit exactly because in this class we're not really interested in the periodic inventory system. We're just concerned with the perpetual inventory system, and we're going to be looking at this from the standpoint of both the buyer and the seller. So in this case, the seller is selling to this buyer, and we're using the exhibit on page 309 as kind of a takeoff point to look at what the transactions look like. So first of all, the buyer purchases inventory from the seller on account. From the buyer's standpoint, this is an increase in the inventory account and a credit to accounts payable. From the seller's standpoint, since they're selling inventory, they not only have to recognize a receivable and a sales revenue, but they also have to recognize a cost of goods sold and credit the inventory for the amount of cost of goods sold. So in this case, the sale part of the transaction is a debit to accounts receivable and a credit to sales revenue for $5,250. Notice that for the buyer, the purchase is an asset account, inventory, but for the seller, the sale is a revenue account because the inventory has actually been sold. The second part of the transaction for the seller is the cost of goods sold transaction. We're just assuming in this case that the inventory net cost the seller $2,100. So the debit is to cost of goods sold and the credit is to inventory for $2,100. Subsequently to the purchase, the buyer returns items to the seller. So in this case, you're going to debit accounts payable. That reduces the amount you owe by $1,750. And then you credit your inventory account. In other words, you're sending this inventory back to the seller. From the seller's standpoint, you have to reverse both the sales transaction and the cost of goods sold transaction. So 2,100 versus 5,250, what we're going to assume is that this $1,750 is going to be in the same proportion, basically. So when the inventory is returned, the amount returned, the sales price is going to be $1,750. Accounts receivable is going to be reduced by $1,750. As far as the inventory amount is 2,100. That's the amount of inventory that's coming back. And then 1,750 is the amount of sale returned versus the total sale of 5,250. So in other words, we're saying proportionately we're getting the same cost back as we did revenue. So in this case, it's 700 and 700, and that settles the books on that. Freight to the buyer is an increase in inventory. That's added to the inventory cost. So if the buyer pays the freight, debit inventory 60, credit cash 60. However, if the seller pays the freight, the debit is to delivery expense and the credit is to cash. Now let's assume the buyer pays the bill within the discount period. In this case, it's $315 net 30. What we have to do is first get rid of our accounts payable. Our accounts payable is going to be $5,250 minus the $1,750 that we returned. $5,250 minus $1,750 is equal to $3,500. So that's the 5250 minus the 1750. Cash is going to be equal to the 3500, which is the difference between 5250 and 1750, times 97%. In other words, they have to pay 3% less, or 97% of the 3500. And then we're going to reduce the amount that we actually have on our inventory account by the amount of the discount. In this case, 3% of 3500, that's 105. So notice how this works. The payable is taken away. The cash amount is less than the payable because of the discount. The discount actually reduces the value of the inventory. In other words, we didn't really pay the full price, we paid $105 less. From the seller's standpoint, the seller receives cash in the amount of $3,395. They recognize the fact that they've given the buyer a sales discount, in this case of $105, and then they take their accounts receivable off the books. That's the credit for $3,500. Now let's say the buyer sells inventory on account, and let's say they sell it for $5,000. Well, in this case, they're getting an accounts receivable for $5,000 and recognizing sales revenue of $5, and then cost of goods sold is $3,455, which is equal to $5,250, which is the original price paid for the inventory, minus $1,750, which is the amount of inventory that we sent back, plus $60, which is equal to the freight charge for the inventory that you purchased, minus 105, which is equal to the discount on that inventory. Notice that the discount, when you compute this discount of 105 up here, it's not, this $60 freight is not included in that discount. In other words, you don't get discounted on freight. For cost of goods sold, the cost of goods sold is equal to your net inventory, which is, like we said, the amount of the purchase minus the amount that you returned plus the freight in minus the discount. So we're reducing the inventory amount by $34.55, and we're debiting cost of goods sold by $34.55. This T account summarizes what's happening with inventory. So we started with a zero balance. That's not necessarily the case, but in this case we're assuming we started with a zero balance. We purchased inventory for $5,250. We returned $1,750. We added $60 for freight, and then we sold the rest, $34.55, to make the ending balance zero. On the seller side, let's assume that we started with an inventory balance of 3. Well, we started with an inventory balance of 3, and then what did we do? We sold inventory worth $2,100. That's down here. And then we received $700 back from before. So net, we've sold $1,400 worth of inventory. So let's compare the income statements. For the buyer, we're assuming the buyer doesn't have any sales returns, allowances, or discounts, although they could. Net sales in this case equals gross sales of $5,000. Cost of goods sold is $34.55, and gross profit is $1,545. From the seller's standpoint, they did have a return and allowance of $1,750. Remember, the difference between a return and an allowance is that a return is when the buyer returns the inventory because they don't like it. An allowance is where they're getting an inferior product by accident, For example, I order a refrigerator from Best Buy and it has a dent in one of the sides. So I want to send it back, but the trucker says, look, if you keep it, I'll give you $500 off. That's a sales allowance. We have to deduct both returns and allowances from gross sales. We also have to deduct discounts to get our net sales. In this case, our net sales are $33.95. In this example, cost of goods sold are $1,400, so gross profit is $1,995. So I hope this illustrates how inventory, purchases, and sales are accounted for in the perpetual inventory system.